Rallies in the PSEi have continuously been met with sell demand. Are we still going to have a Santa rally? Let's discuss. My name is Dan Slim and welcome to another episode of Monday Market Outlook. It's almost the end of the year and growth forecasts slowly coming in. Early in the week, ADB forecasting growth to be at 6% this year and 6.2% next year, in line with government projections of 6 to 6.5% and 6 to 8% next year. Amid heightened geopolitical tensions, World Bank also projects Philippine economy to grow an average of 6% over the next 2 years until 2026, driven by infrastructure spending and business growth. But Pantheon Macroeconomics not so positive, as it expects growth to slow down to 5.4% this year and 5.2% next year. Currently, the Philippine economy only grew by 5.2% in the third quarter, and it will have a lot of growth to make up in the fourth quarter in order to hit the lower end of the government's 6% target. At this point, can our 13-month pay make up for the deficit? Or is this a more accurate evaluation of our economy? Non-performing loan ratio rose to a 2-year high in October. The ratio rose to 3.6%, up from 3.47% in September and 3.44% from a year ago. But Fitch Ratings does expect this to eventually improve in 2025, citing the potential for India, Vietnam, and the Philippines to benefit from lower interest rates and robust economic expansion. But this optimism has not translated into the markets, as the PSEi posted a losing week, declining 1.7% to close at 66.16. Since the Trump sell-off, the market has had difficulty in staging any meaningful rally to push us back into a more bullish scenario going into the last few weeks of the year. Unfortunately, one of the reasons why rallies have been met with sell demand, aside from competition in the bond market, foreign fund outflows, and money flows into crypto, is that the market has been heavily concentrated on just 15 stocks. Now, if we look at the top 15 stocks in the PSE, they comprise 71% of the daily turnover volume, and this market concentration is at its highest in 16 years. And this situation can persist for quite some time, well into 2025, as investors move to safety and will choose only the most stable companies. In such an environment, what investors can do is to cherry pick stocks that are trading below their historical mean, preferably those around 1.5 standard deviations below average. The cheapest among the top 15, SMPH. In fact, it's so cheap that the company is buying back their shares in a show of confidence. SM board has approved up to a 10 billion buyback plan for SMPH, which is down 24% year to date and has significantly underperformed the market. The target price is 38.62 actually for SMPH, representing a potential 44% upside. Now remember, SMPH, more than a condo developer, unlike Ali, SMPH main revenue comes from mall operations, which is expected to improve next year. Now, SM also is one of our picks, right? Now, you may not know that SM Retail also controls the rights to foreign brands like Dyson, Uniqlo, Body Shop, Levi's, Crocs, which should do well in the coming year, as consumer spending is expected to improve next year coming into the elections. On the other hand, URC, with 2.4 points below its standard mean, may look cheap, right? But sometimes there's a reason for it. URC has struggled this year, down a whopping 38% year to date. Commodity prices really have not been friendly for URC. First, we have palm oil hitting 52-week highs since August, and there doesn't seem to be an end in sight, as palm oil prices are expected to rise by another 10 to 15% next year. Coffee prices also reaching an all-time high just last week, right? And outlook for 2025 to 2026, not good as production is expected to decrease by 25% right now. And if you remember, earlier in the year, we mentioned about El Nino hitting the Philippines, and this might affect the Manila water earnings. Really, this kind of weather disturbances does have an impact on global supply chains. This may be a stock market channel, but sometimes we have to talk about, right, politics or the environment. Why? Because of such things, right? These weather disruptions can have an impact on certain companies that we cover. Now remember that coffee is the second most traded commodity in the world next to oil. And the top coffee producers are Brazil, Colombia, Vietnam, Ethiopia, and Indonesia. And you know, the Philippines has Liberica, which is Kapeng Barako, and it is only here in the Philippines that we have that variety. Now, I mean, should maybe the government, right, should have a coffee program here. I mean, guys, coffee, the second most traded commodity in the world, right? So now next, cocoa prices also back to almost all-time highs in April. And lastly, sugar prices are going down, and the recent rumbling in Mount Canlaon has URC on standby as their La Carlota plant is in close proximity, and it is responsible for 45% of their production capacity. URC just can't get a break, no? Not in a good situation right now, not something you should be catching at this point. In other news, ICT's bid to appeal the Durban court decision was blocked, which prompted a sell-off on the stock before price action bounced back to 396. Now let's look at the charts. Unfortunately, after a mild rally, the market sold off last Wednesday, breaking support, putting us back on track to 65.55 for a double bottom possibility. The index bumped its head along this immediate downtrend line and has even broken down this uptrend support. So brace for a bit more weakness, assuming we hit 65.55. Now, if we break this level, the next support will be at 6,400 zone, where if we zoom out, it would correspond to a long-term uptrend line. Now, will this week's anticipated rate cut by the BSP lift the markets towards the end of the year? Now, if we look at the DMI lines here, right, while the selling here has abated, the problem is that there are no buyers in the markets. Now, see how we normally have the buyers come in when the sellers go down, right? So, the buying has also been moving down, no? After the small rally here, the buyers suddenly ghosted the market. Where are the buyers, right? Now, if they are concentrated on just a handful of stocks, will that be a problem for the PSEi entering into 2025? Now, let's look at the charts for our top 15 stocks. AC almost back to our buy zone here. At this point, AC might trade along this range, 611 to 660. Now, SM experiencing also a heavy consolidation along this area. Let's look into the 1-hour chart for more clarity. See how it has been moving along this price range, 870 and 920. Now, it's a bit of a narrow range to trade, but you know, SM, again, as mentioned, is one of my top picks going into 2025. Now, GT Cap briefly touching the 620 buy zone last Thursday before rebounding back to 648. Now, right now, we can see the 100 EMA acting as a dynamic resistance here. Watch out for price action when it hits the 665 to 670 zone. A breakout of this area along 670 could push us back into 700. Now, AEV hasn't had much love this year, really. It's back into the lower 30s and could touch into the 30 to 80 support zone. At this point, unfortunately, it has consistently bumped its head along the 50 or the 20 EMA. And remember, its main drivers, Aboitiz Power and its food business, which isn't really doing that well. So AP would be a better pick than AEV. Both Ali and SMPH also back into their buy zones. And again, we see consistent rejection of the 20 EMA, especially for Ali. It has broken through a key support area here and is hanging on to dear life at 2660. Now look for a basing pattern here before you enter. Now if we look at SMPH, see how the current buy zone, right, is holding. So SMPH looking better here. The same pattern here for BDO and Metrobank, rally and consolidation. But in contrast, BPI has had a sell-off. But you know, BPI among the three banks, it has the best earnings. And this significant sell-off really was an opportunity for us to buy at the 128 range. Now, it had to consolidate along this area before breaking out. Now, if you enter into these type of consolidations, make sure to put a stop loss just below, no, the consolidation area. Plus, has continued its bullish run, no, perhaps in anticipation of good news on their Brazil gaming license. The consolidation height here should be its immediate resistance here at 25.50 or 25.45. It briefly touched 25.30 last Friday. Watch out for price action along the 25.45 area. It's a bit overstretched from the 20 EMA, and this could pull back before continuing its run. ICT currently trading along the 410 370 area. The block on the Durban Port appeal did present a temporary dip, and despite market weakness, it has managed to hold pretty well. Now trade this if it hits 370. JFC still trading along this range. It hit 100 EMA and rejected it last Friday. It could rally back towards 274 if the trend continues. Keeper broke out of a flag pattern here and hit 222. We presented Keeper last week as one of the strongest stocks despite the market weakness. Congratulations if you were able to enter. Lastly, both telcos consolidating at a possible bottom. 2048 has been a good level for Globe, while PLDT trending a bit downwards here, but is back along this most heavily traded zone at the start of the year before its steep run up could be a good potential entry point for both stocks. Now the story really going into this week is the Fed and the BSP rate decision, both happening on Thursday. So both central banks are expected to cut rates by 25 basis points, especially after the CPI numbers came in within expectations. Now, CPI increased to 2.7% over the prior year. In November, a slight uptick from October's 2.6% annual gain in prices on a core basis, which strips out the more volatile food and energy costs. Prices in November climbed 0.3% over the prior month, matching October, and posted an annual rate of 3.3% for the fourth consecutive month. Now, but the November Producer Price Index released on Thursday morning came in hotter than expected, right? 0.4 from the previous month. Economists have been expecting 0.2%. And while the inflation data sealed the deal for a 96% chance that the Fed will cut rates by 25 basis points this week, the PPI data has put the chances of Fed holding rates steady in January in focus, as several officials have voiced a more cautious stance on policy for next year. Last week, the ECB also cut rates by 25 basis points, along with the Bank of Canada, with another aggressive 50 basis point rate cut as worries over Trump tariff threats bring economic uncertainty. A quick look at some of the most traded and strongest issues on the PSE and their dividend yields. Fundamentally, as we continue the rate easing cycle, yield plays, especially for growth companies, could be beneficiaries of the rate cut cycle, We had a back-to-back discount on RCR and A-REIT last week. Congratulations if you were able to pick up both shares. For others like TEL, Globe, and MWC, they are at key support areas, and the rate cut decision next week hopefully may help these issues hold these levels. Now, in terms of technical strength, let's take a quick look at our trends with benefits list, which shows issues that are on an uptrend and are above their moving averages. Watch out for any pullbacks on these bullish issues for a chance to enter if you prefer momentum investing. Now on to the S&P 500, the US markets, shaken by Thursday's Producers Price Index data, ended the week in the red, down 0.8%, erasing the previous week's gains and closing at the 60.44 level. As we move into the second half of December, with the markets appearing overstretched, a pullback towards the 20-day EMA really seemed inevitable. Heading into the Fed decision week, the S&P 500 faces a critical juncture along the 60-40 zone where puts have stacked up, forming a support area here. The index is inching closer to the 20-day EMA, presenting a potential entry for FOMO-driven traders. For now, caution is advised, really. I mean, look at this trend here. Caution is advised against taking a bearish stance, as it could mean going against the current market momentum. As the market consolidates near the 20-day EMA, conditions could be aligning for a breakout in the coming days, with anticipation building for a potential Santa rally to close out the year. If we look at the seasonal chart, the market appears to be following its typical December pattern. Historically, we often see a mid-month pullback followed by a rally. This aligns with the current market behavior. It is possible that the markets could rally into the Fed decision and then a sell on news, and then regain upward momentum as we approach the year's end, potentially fueled by a Santa Claus rally. Now, let's revisit the classic smart money versus dumb money confidence index. Institutional investors, right, are pulling back, while retail investors are increasingly driven by FOMO. Now, traditionally, this goes in opposite directions, signifying some form of market bottom. But this time, right, the imbalance here could raise questions about market sustainability at this stage. Now, is the growing retail confidence here signaling a potential short-term market top? Now, if we take the smart money, dumb money confidence spread into consideration, now while institutional investors may not appear to be particularly bullish at the moment, they are also not overly bearish. We've seen the spread consolidate, reflecting periods of relative stability in the markets. Now, historically, right, during these phases, the market tends to climb steadily upwards with minimal pullbacks. Now, however, right, with all trends, this positive momentum will eventually run its course. That said, there is a potential for this phase to persist maybe in the next 5 to 6 months before significant shifts could occur. While the PH markets may be concentrated, the US market also back into concentration as the Mag 6 continues to push the markets up. But the difference in recent years, as the Mag 6 pulls back, rotation happens into the 494. Now, are we entering into the same stage right now? We can see a consolidation here while the Mag 6 going up, and as the Mag 6 pulls back, could we see the markets rotate back into the 494 to keep the markets up for the short term? Going over to crypto, as we progress into the alt season, we've already seen money flows move into Bitcoin as Bitcoin has hit 100,000, and we have started to see money flows probably into Ethereum in the past weeks. If we look at the ETH BTC chart, Bitcoin has outperformed ETH, but are we starting to see Ethereum outperform Bitcoin in the coming months? Looking at the Ethereum seasonality charts, This shows that we are entering into the bullish months of December, pushing all the way to May of next year. So Ethereum might be the next bull case for crypto in the coming months, right? So that's it for this week. Please like this video if you found the information useful. Please subscribe to the channel for more updates. And again, good luck on your trades. Please manage your risk accordingly, and I'll see you again next week.